It is my privilege to welcome Elke Brink, Wealth Advisor at PSG Wealth R21 from Stellenbosch, to our Women in Investing series. The topic of discussion today, navigating messy markets. Elke, it would be so easy if markets just went up in a straight line. Unfortunately, that is not the case, as recent events have shown us. One little hiccup in the US or Japan and Bloomberg screens across the world go red. So how are we to deal with this? Do we just throw our hands up in the air and say, I can't do investing, it's too hard? Or what strategies do we have to manage this?
Thank you, Kurti, and thank you for having me. It's wonderful doing this Women's Month event and just spending this time together. Now, I think the last week was such a good example again of navigating corrections in the market and market cycles, which is never a great phase for anyone to go through. I think even for us in the industry, when you just see red, it's not a great day. So I think always taking a step back and having that bird's eye view of your portfolio and your planning again, and remembering why we do certain things and why you structure certain asset classes and why do we even have equity exposure. I think if it was as easy as the market's always going up, we would all just have been invested in cash and bonds and rather opting for more safe haven, predictable asset classes, where there's a very good reason why we build in growth assets or equity exposure in a portfolio. And the main reason we try to achieve is to be sure that over the longer term, we can outperform inflation. And that's the main goal for most portfolios, to be able to retain your buying power and ensure capital growth. But unfortunately, that does come with volatility and market cycles. So corrections typically means a downward trend in the market of roughly 10%, but not more than 20%.
Once we reach a bear market.
Not a bear market yet. So when we move closer to the 20% mark, then we start speaking about a market crash, which is also actually quite normal, even if it sounds hectic. But a correction is actually very typical, and it happens roughly every 18 months and needs to be navigated accordingly. But as we see the volatility in the market, like last week, we would have one day where there's an extreme red day and a lot of movement, and the next day, most of it recovered. So knowing that this is more an emotional movement and as the word says, a correction, which is also needed, and to mostly sit on your hands is the best thing to do.
Okay, so knowing these corrections happen fairly regularly, does that mean you can time them?
Unfortunately not. And I think that's the most frustrating part of being an investor and managing investments, is that none of us know exactly when corrections come or other market cycles and to what extent they will be there. But we do know the nature of the market, or the nature of the stock market, is that it always goes up in the long run. So if you take a look at the global market as well as the local market over a 50-year view or even longer, we are in a better place. So year on year, there's a upwards trend, even if there are small movements on a calendar year. So if we actually look at a calendar year in the market, only roughly 50% of the days are positive, which is actually quite interesting. And there, the strategy in your portfolio becomes important when we experience these volatile or negative days that are difficult to digest, is that remaining invested is the only way you can actually ensure positive results in your portfolio. So the only time investors really get hurt or have a bad experience in the markets is if they make a move while there's a downward trend, because then you realize your losses, where if you just remain invested and you just stick to your strategy, then the outcome is very different. So if you, for example, look at the S&P 500 and over a 10-year period, you moved around during volatile times, you would basically be 4 times worse off compared to just remaining invested.
So if you sold,
if you moved to cash, or you moved to a more conservative strategy, because that's typically the human behavior that we tend to want to do. You want to get out of this uncomfortable space
like you're in control,
and move to cash or withdraw. And that's typically where you hurt yourself, where climbing back in and trying to time this, which you just asked, is impossible. So if you miss out on the positive days, so let's use last week as an example. On the Tuesday after our red Monday, the market, the S&P 500 was 2.5% up again. If you miss that recovery, you're completely in a different space, and then you actually realize the losses of the Monday. So it's actually quite interesting when we look at a longer period of time, and if you just miss a few of these positive days in the market, if you, for example, over a 20-year term, just miss the 10 best days, your portfolio is roughly a third of what it would have been. So it's completely detrimental by just missing a few days. I mean, 10 days in 20 years is hardly anything, but just having that strategy in place. And I think always remaining confident again in what is your investment strategy that you either manage with your wealth advisor or whatever your strategy is, knowing where it fits in. And that's where we typically manage asset allocation as well.
I was just about to ask how you mitigate, and to talk to us a little bit about asset allocation. What would that typically look like in a sort of the average investor's portfolio?
I think this is important, and I think as we move through different cycles, this will typically change. So a portfolio is not meant to just stay the same forever. As the world changes and the country changes, we need to adapt our portfolios and our needs, of course. And of course, a youngster who's perhaps 20 years old, the portfolio might look different to someone who is 70 years old and living off their income. So in principle, we use asset allocation to soften the effect of volatility, but also to really complement each other. So using different asset classes in a portfolio, one asset class should not be seen as an alternative to another. So they all play a very valuable role and they complement each other through different cycles. So what we typically want in majority of portfolios is that you want a component of cash and bond exposure for the less volatile components. So typically, if you need an income, for example, or shorter term needs, we would be taking it from these asset classes. If there is a need for just capital growth and you have a 40-year term, then you can, for example, just look at equity exposure. But typically, including cash and bonds would soften this experience. And if you do go through market cycles or corrections or even crashes, and you need some of your funds, you typically take from this. So the idea would always be to have sufficient time in your portfolio to give equities time to recover. So it's actually quite interesting if we look at the history of the market, the biggest crash that there has basically been and the full recovery of it only took around 20 months. So it's actually not very long, and this was worst case scenario, not very long in the biggest scope of any investor's time frame. So
I think investors typically underestimate their time horizon, right?
Yes, definitely.
If you think about a working career of 40 years and possibly another 20 to 30 years after retirement, you've always got a 60-year investment horizon.
Exactly.
If you think about it, that big picture. So.
Yeah, and I think we see it a lot with retirees. The moment you reach almost nearing retirement, then you almost want to go more conservatively, where it's not the right way. If you still have another 30 years left, perhaps.
To have your pension pot growing whilst you're drawing down from it, right?
Exactly. And I think that the role growth assets play to ensure that we are outperforming real inflation. And I think real inflation is a different topic in terms of if you think about your medical aid costs and what your cost of living actually increases with annually. So I think that's a mistake a lot of investors tend to make, is that they want to go more conservative because they don't like the feeling of volatility. But I think it's always important to remember what is this equity exposure? And you are essentially still holding incredible companies that have been researched thoroughly. And it's not that there's something wrong with a company. It's more just the market cycle or an emotional cycle that you're going through. That company is still profitable and well managed. So you're not losing anything in terms of that. It's more just actually the way we see it, of course, is if there are these movements in the market, it's actually a brilliant time to buy.
So, Elke, let's touch on the performance of active versus passive strategies during market corrections. For those of you not clear on the difference, a passive strategy aims to match the performance of a particular index, say the JSE Top 40, minus a management fee. Active strategies, on the other hand, such as those managed by 91 portfolio managers, would aim to outperform a particular benchmark or indice by picking certain stocks or asset classes based on their fundamental research. Long explanation, but
it's a very relevant topic. I think there's always these debates in the market of active versus passive. I'm definitely also more active manager, I think, or believe in active management myself. And I think it's important to understand the difference. And when it comes to managing your portfolio, it's not just about the upside returns and, of course, the positive returns, which we tend to just focus on, but it's also about the downside protection. And that's where I believe active management plays a very valuable role in terms of, if we look at, for example, the S&P 500 at the moment, there's an extreme concentration just to the technology sector at the moment.
Magnificent Seven.
Exactly, the
Yes.
Magnificent Seven. So at the moment, the exposure is roughly, I think, 32% just to, if you were to just track that index. So if something goes wrong in that sector, like the correction we saw, you feel it quite hectically in your portfolio. Where if you had an active approach, typically the active managers would manage the downside effect of exposure to one sector or one equity.
They could be more selective about that concentration risk that you have sitting in those 7 stocks, for example.
Exactly.
And cap the exposure to them.
Yes, so there's almost more of a protection when things go wrong, or that's my experience when you're just tracking an index. So you're just more exposed to whatever the market does if you're simply tracking it. I think with a passive exposure, there's a big belief that it's a more affordable way to do so, but with cost saving comes, of course, also risk. So I think it's important to also ensure what is your strategy and
just be
do you want to have that above index return, and what's the strategy?
Before we conclude, I just want to touch on interest rates. All indications are that we are now entering a rate cutting cycle. So how do you think about asset allocation in this environment where we've reached peak interest rates, starting to see cuts happening around the globe?
I think it's always an interesting topic portfolio-wise. So I think the whole world is really and wanting this rate cut, and it's obviously needed to head into the next cycle. When it comes to our portfolios at the moment, cash and bond exposure actually do extremely well in a high interest rate environment. So typically for the last few years, that was the sector that you could have more exposure in your portfolio, and investors were happy.
Yeah, so high interest rates, high returns on your cash and your bonds.
Yes. So I think also knowing the tax effect that comes with it. So always to remember that this is seen as an income, but those returns were exceptional. You were getting 9-10% returns out of cash and bonds, where that typically decreases now. So as rate cuts start happening, I would always recommend decreasing the exposure to specifically cash in your portfolio. There's always a bit of a lagging effect. So once rates are at an all-time high, bonds do exceptionally well. And it's almost as if you lock in these returns for 2 or 3 year rolling period, depending on which bond you buy. So there's a great value still to be added in that asset class in the next, I would say, 2 years. But typically you want to move out of these asset classes a little bit as the return just becomes too low. So if rates really start cutting, then you have the risk, if you have too much cash exposure, that you are not even keeping up with inflation. So it's something to just be wary of. But it would be interesting to see how fast they would be cutting rates. I think the opinion at the moment is that it would be quite a slow cutting cycle.
And a shallow one as well.
Yes, and a shallow one as well. So I think this exposure is still okay in your portfolio for a while, but I think it's a good time to start moving into growth assets.
Elke, thank you for providing such clarity on these important investment principles. To our viewers, remember that a financial advisor can guide you on an investment strategy appropriate to your investment time horizon and your financial goals. More importantly, they can help you to stay invested during those very stressful market corrections. Thank you.